All right, everyone, welcome. So today, January 28th, 2026, the markets gave us a real head-scratcher. We saw record highs and some pretty sharp drops, all happening at the very same time. So what in the world is driving this conflict? Let's dive in and unpack it.
So the huge story, the one grabbing all the headlines, was the S&P 500. It broke through 7,000 points for the first time ever, a massive psychological win. But it just couldn't stick the landing and ended up closing the day just a hair below where it started. Now, this wasn't just some simple up and down day. Oh no, this was a huge signal of a deep, deep conflict playing out on the world stage. So what is really going on here?
And just look at these numbers. Today's action was a tale of two or maybe even three different markets. On one side, you have the Philadelphia Semiconductor Index, the SOX, which just rocketed up over 2%, running on pure AI optimism. But then you look at the broader S&P 500, and it's basically flat. And then you hop over to Europe, and they're down over a full percent. You see, these are not just random numbers on a screen. They're pieces of a much, much bigger puzzle. Okay, let's start in the US, because today it was really the epicenter of this massive battle between two incredibly powerful forces, the sheer promise of tech innovation and the cold, hard reality of monetary policy. You can see that split clear as day right here. I mean, while the Dow and the Nasdaq had some small gains, just look at that huge gap between the S&P 500, which again went nowhere, and the SOX index, which absolutely exploded up over 2.3%. This tells you the market is not moving together. It's like one sector has decided to break away from the pack with just incredible force. And here's the two competing stories in a nutshell. It's like a tug of war. In one corner, you've got this AI-driven growth story. Expectations are just massive for a huge AI capital spending cycle, and that's fueling all this incredible optimism. But in the other corner, you've got the Federal Reserve being very, very cautious. Today, they announced they're holding interest rates steady. This wait-and-see approach is kind of like putting a governor on the engine, you know? It's keeping the whole market from getting way too hot. And that wild 2.34% surge in semiconductors, yeah, that wasn't just a random fluke. What the quantitative models are telling us is that it's part of a phenomenon they call volatility clustering. Basically, that huge AI-driven shock we saw late last year is creating these aftershocks where big price swings just keep on happening. So this isn't just daily noise, it suggests we're watching a sustained technological supercycle play out in real time. Okay, now let's hop across the pond to Europe and see how their part of the story fits in. Because while the US was having this internal battle, Europe was dealing with a much clearer and, frankly, more challenging set of economic problems. Over there, the picture was pretty much all red. Germany's DAX was down because they had to cut their growth forecast. France's CAC 40 dropped more than 1%, and that was dragged down by a big slump in their super important luxury goods sector. And over in the UK, weakness in healthcare pulled the FTSE 100 down. So it was this synchronized downturn, right? Everybody was down, but each for their own specific reason. Now, the crucial thing to remember is that none of these markets exist in a bubble. And this idea from Ken Fisher just explains it perfectly. He calls it the Great Waltz, where currency flows and valuations connect everything. So today, a weaker U.S. dollar, which came after some recent comments from President Trump, put direct pressure on all those European exporters. It made their stuff more expensive, and boom, it hit their stock prices. And if you want to know why Germany, of all places, is struggling, it really comes down to this key idea from economics called institutional friction. It's basically when a system's own rules and structure resist change, even when that change is badly needed. Germany's slow pace on reforms is creating this economic drag, making it way harder for its powerful economy to adapt to what we call the creative destruction that comes with a digital and AI revolution. So after a day with so much conflict and so much divergence, the big question is, where are we headed next? Let's switch gears from today's analysis and see what the quantitative models are actually predicting for the month of February. And this is where things get really fascinating. You know, despite the S&P 500 going nowhere and Europe's downturn, the underlying quantitative signals are actually pointing to clear skies ahead. It's like the models are looking right past the clouds of today's market noise and they're focusing on these stronger underlying trends that are signaling some serious bullish momentum for next month. So our models, they use this method called Markov chain Monte Carlo simulation. It's a fancy way of saying they run thousands of possible future scenarios to find the most likely outcome. And what are they projecting? Some pretty significant upward moves. They see the S&P 500 rising almost 4% to 7,250. But the real story is in the tech-heavy indexes. A nearly 7% jump for the Nasdaq 100 and over 6% for South Korea's Kospi. The data is screaming that the AI and tech trend is about to accelerate.
Okay, so given this really complex mix of AI hype, economic caution, and these bullish quant signals, how would you even begin to navigate these conditions? Well, the source report proposes a specific strategy for this. It's called the adaptive cycle portfolio.
This portfolio is really built for this exact moment. It's not some crazy all-or-nothing bet. You've got a heavy 40% in AI semiconductors to ride that super cycle momentum we've been talking about. But, and this is key, it's balanced with a 20% slice in gold as a hedge, just in case. Another 20% goes to resilient KSPI blue chip stocks to play those adaptive markets, and then a final 20% in cash and bonds for stability. It's a real balancing act. And this just brilliantly lays out the game plan. See, this is not a passive buy and hold thing. It's about actively taking advantage of that volatility clustering in the semiconductor space. It's about what's called institutional arbitrage, basically favoring nimble economies like South Korea over those stuck with that friction we talked about, like Germany. It's about staying in sync with the market cycles and, most important of all, using strict risk management to protect your capital. So, what's the big takeaway here? This deep conflict we saw today, this battle between the explosive excitement for AI and the cautious economic reality, that isn't just a one-day story. It might just be the defining theme for the markets for a long time to come. And that leaves us with a really critical question to think about. As this one technological force becomes so incredibly powerful, are the fundamental rules of investing being rewritten right here, right before our very eyes?